investing too conservatively could in fact be your highest risk. When it comes to investing, the average assumption has been made that volatility equals risk, which is not the case, and I think it's quite important to understand how you define risk within a portfolio. The investment space can become quite daunting and scary when markets move through different cycles. No one wants to see their portfolio make a 20% movement downwards, of course, in any given time. But this is very natural and part of volatility, and this is what you experience when you have equity exposure. I think it's incredibly important to define what risk means in a portfolio and what your perception is of what risk is. If we refer to a cash-based investment or a money market investment, for example, I think the experience here for the average investor is that it's a safe haven asset and your capital is protected. But this is not really the case when we really take into account what we are trying to achieve with a portfolio. We need to ensure that your capital is keeping up with inflation and keeping up with real buying power. To be able to achieve this, we need to outperform inflation. If you're just invested in a cash-based, low-risk asset class investment, you are essentially losing buying power on a day-to-day basis, as inflation is depleting your capital. In the longer scheme of things, we need to ensure that your portfolio is not only outperforming inflation, and inflation becomes a very relative term here, as we need to plan for real inflation. This accounts for medical inflation, cost of living, electricity tariffs that's being hiked, taking all the realities of real cost of living and real increases in your portfolio and in your day-to-day life into account. This can only be achieved by including growth assets or equity exposure in your portfolio, as this asset class is the only asset class that outperforms inflation over the longer scheme of things. It's important to understand that equities or growth assets being invested in the stock market will always move through cycles. Cycles are not risky, it's just volatility. And it's important to ensure that the strategy in your portfolio plans for this. There's a reason asset classes are combined within a portfolio, and one should not be seen as an alternative for another. In the shorter scheme of things, and I would say an investment time from 1 to 4 years, we ideally do want to structure cash and bond asset classes, low volatility, consistent returns, and ensuring you don't feel the effects of volatility in the stock market. Over the longer time frame, equities will always give a positive return over and above inflation. It's just important to ensure that you can ride out the different waves in the stock market. It's quite interesting when you actually analyze the positive days versus negative days in the stock market, and it ends up only being around 50% of the time that you do have a positive day in the stock market. It's just that it's impossible to time those days and to know exactly when they will be. But missing out on these positive days can have a detrimental effect on your portfolio. If you just had to miss out on 10 of the best days over a 20-year period, your portfolio would be roughly a third of the value it could have been. So ensuring we don't try to time the market, but rather just spending time in the market is how you can ensure that you are building a resilient portfolio. It's important to understand with these volatile asset classes that you do need to provide them with time. So ideally, if you want exposure to growth assets in your portfolio, we do want to have a time frame of 5 years and longer to account for any downwards market movement that can possibly happen. The only time when you can really hurt yourself in a portfolio is if you are invested in volatile assets and you require to make a withdrawal from these assets in a non-ideal time. So equity exposure is unpredictable in terms of positive returns. You can have a year like 2021 where you have 20 to 30% returns on all your portfolios, but you can also have a year where we have a pandemic or a war or some other unforeseen event where you can have a downwards movement of 20% in your portfolio, and ensuring you don't access your portfolio or the equity components of your portfolio in this time would be imperative. So if you've realized that you are perhaps in a more risky position than you have assumed to be by being invested too conservatively, reach out to us at PSG Wealth R21 and we can assist you with the recommendations on your asset allocation.